They just came out and told us that the bank is shut
Of
down.
the US-based Silicon Valley Bank, it prompted fears of a full-blown crisis in the sector.
Meanwhile, Signature Bank marks the third largest bank failure in U.S. history.
They dropped by more than 14% on Friday.
And SVB, absolutely a problem child.
In recent weeks, we have seen a collapse of the U.S. banking system, especially around the tech-focused banks like Silicon Valley Bank and the two crypto-centric lenders, Signature Bank and Silvergate Bank. The failure of these banks is causing a much more deeply penetrating effect on the U.S. financial system and the European financial systems. These sudden failures of Silicon Valley Bank and Signature Bank are recorded as the second and third largest bank failures in the history of the United States. Between 2001 and 2022, 561 bank failures have been recorded. However, out of all these 561 bank failures, 83% of them happened during the Great Financial Crisis, GFC, between 2008 and 2012. So the annual bank failure rate is less than 10 when considering the situation of 4,500 FDIC-insured banks that exist globally. However, bank failures don't happen within the U.S. economy very often, and there were no records of bank failures in 2021 or 2022. So, is this the first major sign of a recession? We're going to answer this question throughout this video. But before we proceed, hit the subscribe button and smash the bell icon for more exciting updates. All those failed banks specialized in a particular field. They failed for different reasons, but followed the same mechanism. When we analyze the failure mechanism, the main four phases can be identified as follows. Banks received a large deposit influx in the period between 2020 and 2021. So, these banks invested that money in high-quality securities. But the Fed increased rates at an unprecedented level, exposing banks to duration risks. In the final phase of the collapse, bank runs can be identified. As we identified, a large influx of deposits was observed during the period of 2020 to 2021 when there was a negative interest period. During that period, government stimulus flooded the economy with excess cash, and most of that excess cash ended up as deposits in the banks. According to the statistics, deposits in U.S. banks rose by $5.4 trillion. This was a huge problem to every bank, as there should be a sufficient investment method for that excess money. With that excess money in the economy, most people didn't want to borrow money from banks as they usually did to fulfill their day-to-day needs. Loans were the main source of income for banks, but according to the report published by JP Morgan, only around 15% of deposits were lent out, resulting in a major loss of income for banks. When banks lost this major source of income, they opted to invest money in high-quality debt instruments like U.S. Treasury bonds, mortgage-backed securities, etc. Although this is a great investment option in most circumstances, it's not currently a good option, as we're not living under normal economic conditions. Last year, the Fed decided to increase interest rates at a fast rate never seen before. Banks were not expecting such a move from the Fed, as there was no indication of it from the Fed's statements over several months. The Fed assumed that inflation was something temporary, with the disruption of supply chains due to the corona pandemic. After dealing with rising inflation for several months, Feds understood that this is not temporary. So the Fed suddenly changed its stance, turning more aggressive with interest rates to control inflation. This was a huge blow to the operational plans of banks, which were mainly based on the Fed's projections. In the final phase of this collapse, we can see a run on the bank. Even though many banks experienced the first three phases of the collapse, the damage was not severe up until the last phase. Unfortunately, things were out of control for Signature, SVB, and Silvergate. When the number of withdrawals is increased at a rapid rate, banks run out of funds to fulfill those withdrawal requests. In an immediate cash requirement, banks have only two options. They can either accept more deposits or sell off their investments to acquire more cash. The first option failed for tech-based and crypto-centric lenders like Silvergate, Signature, and Silicon Valley banks, as the deposit rate was drastically reduced with the crypto winter and tech downturn. The second option was possible, but making such a decision suddenly causes more losses. Now, the crisis is not limited to just the banking sector of the United States, and it's slowly spreading towards other main global economies too. The most recent collapse is recorded from Switzerland with the failure of Credit Suisse last week. It would borrow up to $54 billion from the Swiss National Bank to maintain its operation. This 166-year-old experienced lender started collapsing after investors dumped its stock as fears arose about its financial health. This is not directly connected to the causes behind the collapse of SVB or any other U.S. financial institution. However, economists are pointing out the fact that violent market reaction was a sign that investors were growing concerned about the stability of the broader system. Why would a bank crisis make a recession more likely? As inflation slowly reaches a very critical stage, all governments around the world are taking action to prevent the recession. But the unpredictable nature of the ongoing economic climate is not an easy thing to deal with. The United States Federal Reserve made a quick decision to increase interest rates with the aim of raising the cost of borrowing and discouraging consumer spending. In a recent poll conducted by the World Economic Forum among economists, 2/3 of respondents believe there will be a recession in 2023. But the good news is, most analysts expect a mild and short-term recession. Stephen Fazari, a professor of economics at Washington University in St. Louis, said, "If regional banks become more conservative about who they make loans to, it could spill over to less demand, less sales, and a slowing of economic activity." Is it serious enough to cause a recession by itself? I would think not, and certainly not as serious as what happened in the global financial crisis. Goldman Sachs has predicted a 35% chance of a U.S. recession within the next 12 months. And that's a clear improvement of 25%, which was predicted by Bloomberg earlier. Expressing her idea about the ongoing economic situation, chief U.S. economist at Oxford Economics, Ryan Sweet, said, "It's going to feel uncomfortable for a period of time, but I don't think this is going to turn into a full-blown repeat of the financial crisis." She expects a mild recession in the latter part of this year, with the Federal Reserve being too aggressive in raising interest rates. Right now, households, corporations, and local governments are flush with cash, Sweet says. That should help limit the severity and duration of the recession. However, there is still a minority of experts that believes that the condition will be under control before developing to the point of recession. One such expert is Mark Zandi, who is Moody's Analytics chief economist. He predicted that the Federal Reserve will hold off on a rate hike in the near future. So Zandi is not expecting a recession and expects a soft landing. Talking about the possibility of a recession, Mark Zandi said, "I don't think people should underestimate the impact of those lower rates. Mortgages will go lower, and that should be a lift to the housing market. But without current evidence, no one can predict exactly whether the recession is coming or not. However, early signs are not good, and even the Federal Reserve expected such poor economic conditions a few months ago. So preparation is very important to avoid the development of conditions leading to a recession. The Feds have enough experience in dealing with major recessions in 1990, 2001, 2008, and 2020. But all those recessions are related to major events, like Iraq's invasion of Kuwait, the September 11th terrorist attacks, the collapse of Lehman Brothers, and COVID-19. In the first 3 major recessions, the economy was considerably weak, and there was clear evidence of a potential failure. But this time, the situation is somewhat different, and even the best experts have no clear idea about the ongoing economic situation. However, most officials in the central bank have the experience of dealing with the Great Recession in 2008, and will surely do something to drive the American economy out of danger. What do you think about the sudden collapse of the U.S. banking system? Will it lead to a recession in the latter part of 2023? Share your thoughts in the comments section below. Thank you very much for watching the video. If you enjoyed the video, subscribe to the channel to get more exciting economic news. See you guys in the next video. Goodbye.